War. The moment that word appears in the news, markets start shaking, people start panicking, and money starts moving. Most investors think war destroys wealth. That's only half the truth. Because while most people panic, freeze, or sell at the worst possible moment, a small group does the opposite. They stay calm, they understand what's actually happening, and they position themselves before the headlines catch up. This video is not about profiting from suffering. It's about understanding why war is one of the biggest wealth transfers in history, and why most people end up on the wrong side of it. If you want to know how money really behaves when fear takes over, why panic is more dangerous than the war itself, and how smart investors think when everything feels unstable, then watch this until the end, because one emotional mistake can erase years of progress. When people think about investing during a potential war, most conversations start in the wrong place. They jump straight to extreme scenarios, quick profits, or the next asset that might explode. Gold here, defense stocks there, maybe even some secret strategy that only insiders supposedly know. But history shows something very different. In times of serious geopolitical conflict, the biggest financial mistakes are usually not made because people lack information, but because they react emotionally. Fear, panic, and short-term thinking tend to destroy far more wealth than the crisis itself ever does. War changes priorities. In stable times, investing is mainly about growth and optimization. In unstable times, it is first and foremost about survival. Markets can drop sharply, currencies can lose value, and governments can introduce new rules almost overnight. That is why, before thinking about returns, it makes sense to make sure your financial foundation is solid. This means having enough liquid money to cover your basic living expenses for several months, reducing unnecessary debt, and making sure you can access your money even if markets are temporarily closed or highly volatile. Cash may feel unproductive, but in times of crisis it provides flexibility, and flexibility becomes extremely valuable when others are forced to sell. Another key principle is diversification. In calm periods, diversification is often treated as a nice-to-have. During war, it becomes essential. No single country, currency, or asset class should dominate your entire financial situation. Conflicts affect regions very differently, and what performs well in one part of the world may perform poorly in another. Spreading investments across asset classes, regions, and currencies reduces the risk that one single event wipes out a large portion of your wealth. The goal here is not to maximize gains, but to reduce the probability of catastrophic losses. Historically, real assets tend to play a more important role during times of conflict. When uncertainty rises, trust in institutions and paper promises often declines. Assets that represent something tangible, such as energy, raw materials, or essential infrastructure, usually remain relevant because society continues to rely on them regardless of political conditions. This does not make them risk-free, but they are often less dependent on optimism and more tied to real demand. At the same time, it is important not to confuse long-term positioning with short-term speculation. Investing based on headlines or emotions often leads to buying at inflated prices after markets have already reacted. Sectors like defense and energy are frequently mentioned in the context of war investing, and for understandable reasons. Demand for security and energy does not disappear during conflict. However, that does not mean buying these assets at any price is automatically a good decision. Political intervention, regulation, or price controls can limit profits, and in some cases, governments may even take direct control over strategic industries. For investors, this means exposure should be carefully measured and embedded into a broader strategy rather than treated as a guaranteed win. Just as important as knowing what to consider is knowing what to avoid. Highly leveraged investments, speculative hype-driven assets, and businesses that rely heavily on global luxury consumption tend to struggle during times of war. Uncertainty reduces predictability, and assets that only perform well under ideal conditions are usually the first to break when conditions deteriorate. In these environments, stability often beats complexity. One aspect that is often underestimated is the value of personal skills and income stability. While markets fluctuate and rules change, your ability to generate income remains one of the strongest forms of security. Skills that are in demand, adaptable, and transferable across borders provide a level of independence that no financial product can fully replace. Investing in yourself, your education, and your earning potential is therefore a crucial part of any long-term strategy, especially in uncertain times. At this point, a natural question arises. What does being prepared actually look like in practice? Because it's easy to say stay calm or diversify. But building a setup that still works when things get messy is the real challenge. Many people either overcomplicate everything or freeze completely. A helpful way to think about it is to give your money different jobs. One part needs to be instantly available and boring. Another part needs to be stable enough to prevent panic decisions. And another part can remain growth-oriented, because even during conflict, life continues and the global economy does not turn into a permanent downtrend. Structuring your finances this way reduces the chance of emotional mistakes when volatility spikes. This also brings us to currency risk, which many people only notice once it becomes painful. In conflict scenarios, currencies can move faster than stocks. If you earn in one currency, save in the same currency, and live in a region that might be impacted, you are taking a concentrated risk without realizing it. The goal is not to predict which currency will collapse, but to avoid tying your entire financial life to a single outcome. For some people, that might mean holding part of their emergency funds in a second, widely accepted currency. For others, it simply means global diversification in long-term investments. Access is another often overlooked factor. Not just whether you own an asset, but whether you can actually use it when needed. During crises, temporary restrictions, delays, or technical problems are not uncommon. Keeping everything in one bank, one broker, or one platform creates a hidden risk. Spreading access can be just as important as spreading assets, even if it feels inconvenient in normal times. At the same time, it's important to avoid extreme reactions. In uncertain periods, some people turn their finances into a bunker plan. They buy assets they don't understand, hide money in inefficient places, or move everything into something that feels safe but quietly destroys purchasing power. Real security is not about comfort. It is about resilience over time. And resilience usually comes from simple, robust structures rather than complex ones. Markets themselves behave in more nuanced ways than many expect during war. The common assumption is that conflict automatically means markets crash. In reality, markets price expectations, not events. Sometimes markets fall before a conflict escalates and stabilize once uncertainty becomes known. Other times, conflict spreads and the downside continues. The key takeaway is that trying to trade war headlines is one of the fastest ways to lose money, because you are competing against institutions that react in seconds, not days. That is why a rules-based approach matters. If your plan is to decide based on how you feel in the moment, then fear will eventually make decisions for you. A better approach is setting rules in advance, such as rebalancing at fixed intervals or investing regularly instead of trying to time the perfect entry. These methods are not exciting, but they are effective because they remove emotion from the process. Another uncomfortable reality during war is inflation. Conflict disrupts supply chains, increases government spending, and puts pressure on energy and food prices. Even if markets are volatile, everyday costs can rise quietly. That means the risk is not only market crashes, but also a slow erosion of purchasing power. Staying too defensive for too long can therefore be costly. Cash provides safety, but over extended periods it can lose real value. This is why balanced exposure matters. Enough safety to avoid forced selling, but enough exposure to productive assets to keep up with long-term economic reality. Globally diversified equities still play a role for many investors, not because they are stable during war, but because over long horizons, ownership in productive businesses has historically helped recover purchasing power after major shocks. Gold is another topic that often comes up. It is sometimes treated as a perfect crisis shield, which it is not. Gold can act as a stabilizer in certain scenarios, particularly when trust in currencies or institutions declines, but it works best as a small, insurance-like component within a broader plan. When it becomes the entire strategy, diversification is lost. In the end, war investing is mostly psychological. Even the best portfolio fails if the investor cannot stick to it. Constantly refreshing news, watching every chart, and reacting to every headline increases the likelihood of making a decision at the worst possible moment. Crises punish impatience and reward discipline. So the real goal is not to predict the future. The goal is to build a financial structure that can survive multiple futures. And if your setup can handle stress without forcing you into panic moves, then you are already ahead of most people. If this video helped you think more clearly about investing in uncertain times, consider subscribing. On this channel, we focus on long-term thinking, rational strategies, and understanding money beyond headlines. Thanks for watching, and I'll see you in the next video.